And for more on Europe's future, Philip Yen sat down with Jacob Kirkegaard. He's a senior fellow at the Peterson Institute for International Economics here in Washington. And Phil asked him his outlook on Europe's economy for 2016.
I actually think that from a sort of macroeconomic point of view, 2016 looks pretty good for Europe. And because we should remember that 2015, actually, where I would expect year-end growth to be somewhat like 1.6, 1.7%, that's above Europe's potential growth rate. And I expect next year to probably be marginally better, so 1.8, 1.9%. And this is fundamentally because of two things. One is continuing very important monetary stimulus from the European Central Bank, which will now continue into 2017. But also, and this is directly related to the security issues and the refugee crisis, a more lenient fiscal policy. Because one thing we're certain of is that when you have a million plus refugees arriving, that costs money in the short run. So European governments, particularly in Germany, are spending more money as a result of that. And meanwhile, of course, the euro exchange rate remains relatively low. It didn't, go to parity, but at the same time, 1.1 to the dollar ensures that European exports will do just fine, in my opinion. And then, as long as we have low energy costs globally, that's really, really good news for Europe, because Europe imports 80% of its energy.
We are investors, and you have, let's say, a couple $1 million in your retirement plan. And it's all in cash. And I say, all right, Jacob, you like Europe. Pick 3 countries. Which 3 do you pick to buy?
I think the first one I would pick would be Germany. The second one would be Spain. And then the third one, and this would be the most risky tranche, would be Greece. Because I think Germany is a country that will continue to do well. It'll be a country where you will see, Germany is already close to capacity, and I think you will see in the coming months and quarters a bit of a mini boom developing in Germany because of the inflow of refugees and because of the generally, and this on top of already a strong economy. Spain is recovering quite well. Growth is going to be about 3% this year. I would expect that to continue next year. And I think Greece is a country that has fundamentally been beaten so far into the ground that quite literally, if they manage to have a stable government, the only way is up. And I think one thing that they have learned over the last 6 to 9 months is that they're not going to have another self-inflicted, government crisis in that country, because they know that ultimately it's futile. So there's a country there that could surprise on the upside.
Any particular 1 or 2 countries you would avoid?
I think Portugal is one to look out for, because I think the new government there, which is a leftist government, will find it very, very difficult to fulfill both the promises that Portugal has made to the European Union, to budget stability, etc., and all the very, in my opinion, excessive spending promises that they have made to Portuguese electorates. So that would certainly be a potential downside, in my opinion.
A lot has been made about China's slowdown this year, how it would impact the U.S., how it would impact Europe, for example. But it seems to me, in looking at all the data between the U.S. and Europe, 2 of the major trading partners, that it's been fairly minimal. There hasn't been much of an impact. Is that correct?
Yeah, I think certainly if you look at the U.S. recovery is continuing. It's not a stellar recovery, but it's a steady recovery. And in the case of Europe, we're also moving into that more steady recovery phase, where, like is the case in the United States, it's been domestically driven. And this is increasingly the case also in Europe, where, yes, there has been a bit of a slowdown recently in German exports to China and other emerging markets. But the reality is that those decreases in export growth have been more than compensated for by domestic demand. And therefore, the main source, arguably the main benefit, in fact, for Europe at least, for the slowdown in China, is the very significant downward pressure that this has put on global energy prices. Because, as I said earlier, the lower the oil price is, the unambiguously better that is for Europe.